start with let's start with the intrinsic value difference and the stock price. Now, so when we say intrinsic value, that is actually a true price of the stock. So that is the true price of the stock. Now, when we use the term true price of the stock, so we have to determine the price of the stock. So we can determine the price of the stock by using different valuation models. One example is the zero growth. So this one is a zero growth actually. No? So that is the price of the stock at year 0 is equivalent to dividend at year 1 and divided by the required rate of return or the cost of capital. Now, if it is a constant growth, then we have this portion, RE minus G. No? That is if there is a constant growth, no, for the company's performance. So based on the intrinsic value, this is the true price of the stock. So we have to determine it by using the valuation methods or different valuation models. No? Now, the difference when it comes to the stock price is that we are using yung perceived price of the stock. So this is something that can be observed. So this one you cannot observe. No, at all, you cannot observe. Kasi you have to compute for the price of the stock using the different valuation models. But for the stock price, we're saying that is based on the perceived price of the stock. So something that can be observed. No? So where can we get the information for this one? So we can see this from the newspaper. Alam mo, nanginginig pa ako class hanggang ngayon. No? Hindi ko alam kung na-COVID ako eh. Pero yung mga kapatid ko kasi nagkaroon. So anyway, so we have the newspaper as one of the bases. And then another one is of course yung mga websites, no? Websites coming from yung providers, no? Yung mga providers ng yung mga on-sites. Pwede na rin websites sabihin, no? So websites for example ng mga stock brokerage companies, no? Marami yan, may mga ICBC Securities, no? AB Capital. May iba siguro gumagamit sa inyo yung call financial, diba? So if some of you are already into stock market, so maybe you know this. So example nito ay ito, papakita sa inyo. So this one, nakikita niyo ba class?
Yes po, sir.
So these are the prices, no? So this is the performance today, actually. So ito yung price nila, 1.56, 12.42 for the LR pala, for ABS, 12.42. So these are the prices, the observable prices of the stock. Okay? So makikita yan natin sa mga websites or sa mga platforms ng mga stock brokers. So this is something that we can observe, no? And then we can use also the charts if you want. So for example, tignan natin yung nickel, no? Ito yung paborito kong mga stock, mga nickel, no? O yung mga FCC. So example natin ito. This is something that can be observed, diba? Makikita mo yung pattern ng price ng stock. If it is going up or going down, diba? So by the way, this is a candlestick. Baka hindi nyo pa naintindihan yan. Pagtan natin. Gawin natin ng line. So yan. So this is the, yung mga tip, yan, yung mga edges niyan, no? Yan yung mga price ng stock. So this is something that you can observe. You do not have to compute, kasi you have to observe. And then from that line or those points or line, you will determine what will be the price of the stock. So you're forecasting based on trend. So tulad dito, nakita nyo pataas, no? Tapos bumaba, tapos pataas na naman. So probably you can expect that the price of that stock the next day of trading will increase. So something that you can observe. But doing the valuation model, you cannot. Because under the valuation model, we have to compute, we have to analyze. And under the intrinsic value, under the intrinsic value, so under the intrinsic value, when it comes to risk, we're trying to compute also for the risk or look at the risk. Sandali lang class, balikan nga, di ba? So we look at the risk also as the true risk. So, yun yun, no? We have to look for the true risk also. Dito naman sa stock price, we have the perceived risk naman. Perceived risk. So yung perceived is perception, no? But here, we also look at the true risk. Okay? And then something that we have to analyze by using valuation models, different valuation models. But this one, we have to look at the perceived price, no, in perception, and even the risk. There is a perceived risk. Now, however, no, if these two, the intrinsic value and the stock price, are equal or the same, then we can see that they are at equilibrium. No, nasa equilibrium sila. But most of the time, they are not in equilibrium. No, hindi siya equilibrium. Why? Because even if they have the same information, let's say, alam na nila yung mga information. Saan ba nagagaling yung mga information na yan? Yung mga information, maybe in the form of yung news, yung economic information, no? So, kahit na pare-pareho yung mga information nila niyan, but because they have different, no, interpretation of those information, the reason why they have different perceived price for the stock. The same thing with the valuation of the models, no, using the valuation models. Some of them might think that the company may have no growth. Some of them may think that they have growth. So nagkakaiba pa rin sila, no? But anyway, the difference between the intrinsic value and the stock price will help us determine if the stock is undervalued or overvalued. So for example, so let's say the stock price, no, in the market is, let's say, 20 pesos. No? So let's say yan. Now, based on your computation, money intrinsic value, based on your computation, is, let's say, 15. No? So again, let's say our example is that the stock price in the market is 20. Now, based dun sa pinakita ko sa inyo, no, yung dito. So let's say ganyan. So based on that, the price of the stock is at 20. Pero based on your computation, it is only 15. So ano ibig sabihin nun? So it means that the price is overvalued. So overvalued siya kasi ang price sa stock market 20. Pero based sa computation mo 15. So overvalued siya. So this time you will make a decision if you will buy or not the stock. No? So the other way around, kung bawang ito naman ay 20 at ito ay 25, no? So parang lumalabas siya undervalued. Kasi the true value of the stock is 25, but it is only selling the market at 20. So undervalued siya. So again, you will make a decision if you will buy or not the stock, no? Based on that. Okay, so we're done with the difference between the value, intrinsic value, and the price of the stock. Now let's go to the risk-return trade-off. Now for the risk-return trade-off, to attract investors to take more risk, an investment should provide higher expected returns. No? So kaya sinasabi natin, the higher the risk, the higher the return. But sometimes, this statement is actually wrong. No? Ito. Kasi the higher the risk, the higher the return daw. But even if it has a higher risk, it is possible that there is a higher loss. No? Kaya nga lang, the general conception is that if you are to invest in a risky investment, then that risk should be compensated by an additional return. No? Kaya kung mataas yung risk, halimbawa ito yung investment risk natin, nandito yung investment return. So as the risk increases, dapat yung return natin tumataas. No? Kaya kung nandito yung risk, nandito lang yung return. But if the risk is here at this point, then the return should be at that point, mas mataas. So that is the general idea with regard to the higher risk and the higher the return. Because you're asking for more premium for taking that risk to invest in that particular security. So what is risk? No, so risk is the exposure to uncertainty or danger resulting to changes in the expected return in a given investment. So ito, na-review na lang din ito, lalabas sa atin, di ba? Dahil pinag-aralan na natin ito sa financial management. Now, we have two types of risks. So one is the systematic risk, and then the other one is the unsystematic risk. So when we say systematic risk, so these are non-controllable risk or undiversifiable risk. So this is something that we cannot control. No? So for example, yung pandemic ba na to, itong pandemic na to is an example of a systematic risk. Because regardless of how diversification you will do, now we will be affected. And actually, the entire world was affected by this pandemic. No? Now, the unsystematic risk, this is sometimes called controllable risk or diversifiable risk. Because it simply means that it can be controlled. No? And the unsystematic risk, this is a kind of risk that can be associated only to a particular company or for a particular industry. So if that particular company or particular industry is affected, the other industries might not be affected. Kaya kung nag-invest ka doon sa industry na affected, by investing in those companies or industry which is not affected, then you already diversified your portfolio. No? So yan yung unsystematic risk. Now let's go to the computation of dollar return. Okay, tapos ito, no? So total dollar return or peso return, tutusin, no? Kasi I think this, no? I use the PowerPoint of macro, yung kay Jordan 2, no? I took it from Jordan. But actually, I made some improvement, no? On the PowerPoint. So anyway, the total dollar return or total peso return, so whatever currency, basta total return yan. So that is the return on an investment measured in dollars, accounting for all interim cash flows and capital gains or loss. So example, no? Kung let's say you invested 10,000. You invested 10,000. Tapos at the end of the year, it went up to 11,120. Tapos you received dividend of 80. So the total return is the difference between the two. So that is 1,120. So ito yun. And then of course you have the 80, which is your dividend income. So the total return now, once added, is 1,200. No? So diretso ko na class, ha? Now, since the investment made is 10,000, if you want to get the return in percent, so you simply divide yung 1,200 against the 10,000. No? So that is the total dollar percentage return naman. Diba? Now, if you want to get the capital gain in percentage, so you simply divide the 1,120 against 10,000. And then if you want to get the dividend return in percentage again, so yung 80 divide mo lang sa 10,000. Kaya yung total return na 12%, no, hatiin lang natin into dividend gain at saka capital gain in terms of percentage. So nandito na siya. No? So, wala pala rito. Pero yun yun plus. So anyway, there is a different example here. So we have the total percent return. Ito. So percent return ang kinukuha natin. So again, there was an investment of $50. Then it went up to 55.60. So meaning there's a capital gain of how much? 560. So ito siya, di ba? Kasi yung difference nitong dalawa. And then you have the dividend income, which is 0.40. So ito naman yun. So you have the 0.40 plus of 5.60 divided by 50 kasi ito yung amount of investment. So we have now the 12%. Okay? Now if you want to get the breakdown, iba na namang example ito. No? Iba example na naman siya. So let's say meron tayong 1,400 na in-invest stock and the share price was 35. Then it went up to 49. No? And then you receive also 1.40 dividend. So yung capital gain natin is actually 49 minus 35. So which is 14. Kung bumili ka ng stocks, no, let's say we divide this 1,400 by 35, makukuha natin is 40 shares. Diba? Then since the capital gain is capital gain is 14, so 40 shares times 14, so we have capital gain of 560. And then since you have the dividend of 1.40, so yung 1.40 times 40, so you have 56. So brinake lang natin sa bali ngayon, no? So in terms of total dollar return, so you simply add these two. So the reason why we have 616. And then for the total percent return, yung 1.40 divided by 35, kasi ito yung cost natin, 35. So 1.40 divided by 35, so that is 4%. And then for the capital gain, yung 14 divided by 35, so ito yun, makuha natin 40%. No? So simply adding these two, so that's why you have the total percentage of 44%. Or if you want, now you can use the 616, this one, then divided by the 1,400 investment, so ito yun. So you can simply divide the 616 by the 1,400. So you get the 44%, which is the same as this one. No? Pareho lang siya. Okay, clear ba? Question, class, or clarification? Anyway, i-upload ko na lang din itong PowerPoint na to sa inyo, no? For your recall, just in case, no? For your review. Okay, so annualizing returns. So how do we annualize the return? Also, what is an annualized return? So one under the annualizing returns is the effective annual return. So that is the return on an investment expressed on an annualized basis. So example tayo. So you buy some shares of Cisco system at $30 per share. And then 3 months later, so take note of 3 months, you sell these shares for $31.50 per share. So you receive no dividends. So what is your return and what is your annualized return? So for you to get the return, so meron tayong $31.50 minus $30, all over $30. So you get 5%. So anyway, the 5% is actually the return for the quarter. So how are you going to annualize it? So ito yung formula na, no? So we have the 1 plus 1 plus the year. So 1 is plus the holding period percentage return. Then meron tayong M. And that is the period, number of period in a year. But actually, kasi to make it correct, maglalagay tayo dapat ng -1. Kasi si Jordan, ang ginawa niya, automatic tinatanggal niya na lang yung 1. No? But if you want to have a better formula for that, dapat lagyan natin dito ng -1 dito sa dulo. No? So, going back, to compute for the effective annual return, ano yun? So we have 1 plus 0.05. Ito yung na-compute natin na return kanina for 3 months. And then we have 4 here. Bakit 4? Because we have 4 3 months in a year. Diba? Kasi 12 divided by 3, so 4. So kaya 4 yung nakalagay dyan. No? So then now you get 1.2155. So again, we have to drop the 1. No? Kaya dapat may -1 dito. No? So 1.2155 minus 1, so you get 0.2155 or 21.55%. Okay? Clear ba yan, class? So just do not forget, no? If you will not put the -1 there, pagka na-compute kayo ng ganito, so you just drop 1. Kaya na baka makalimutan nyo pagka i-drop yung 1. So better to include -1 in the formula. So that once you obtain yung 1.2155, automatically -1. So you will get only 31.55%. So that is already your effective annualized return. Okay, next. What is the historical average returns? No? So for the historical average return, so we simply get the number of years, no, as a divisor, and then we add all the returns. So meaning, if you have 2016 to 2019, and this is 4 years, di ba? 4 years yung lalabas, you simply add all of this. So once you added, and then divided by 4, you will get an average of 20%. Or if you want, no, ito yung formula natin, you have 42% plus 12% minus 30% plus 56%, then divided by 4, you get 20%. So that is the historical average return. No? So kumbaga, yan yung simple average lang. It is only the simple average. So for this one, average annual returns and risk premiums for 5 portfolios. So in the example given by Jordan, he mentioned yung mga large company stocks coming from the top 500, no? Stocks from the Dow Jones, no? Dow Jones. And then we have the small company stocks. So he took the lower 20% of the New York Stock Exchange naman. And then you have the long-term corporate bonds, the long-term government bonds, and then you have the US Treasury bills, no? So anyway, among them, si Treasury bill, yan yung less risk, or actually risk-free investment. Kasi if we go back, no, if we go back to your determinants of interest rate, for you to complete the R, o R yan, o kaya lagyan na lang natin sa papel, no? Lagyan na lang natin sa papel, bawa dito. So for the R, yan yung tinatawag natin na R star plus the inflation. So this is what we use for the T-bills. Diba? For the T-bills. So we simply include the inflation premium from the risk R star natin na to. So ibig sabihin kasi ng R star, ito yung risk of rate of return without the consideration of the inflation. So, but once you included the IP from the R star, then it becomes a risk-free investment. No, small R dapat yan. Now for the treasury bond, no? The formula is we have the R star plus the IP plus the MRP. So which is yung MRP natin is actually maturity risk premium. So meaning, the T-bonds is more risky than T-bills. No? Kasi yung T-bonds na to, ibig sabihin lang yan, they are long-term investments. But actually, risk-free investment pa rin ito. Bakit? Kasi it is supported by the government. No? Government. So meaning, the payment of which is guaranteed by the government. Kaya lang nga, mas mataas yung rate ng T-bonds compared to T-bills because it is long-term and because of the maturity risk premium. Now, what about yung corporate bonds? Pagdating sa corporate bonds, yung formula naman natin dyan ay R star plus the IP plus the MRP. No? Yung corporate naman, no? Corporate bonds. Pero dito may dagdag pa na default risk premium plus the liquidity premium. No? So yan. Meron tayong ganyan, no? So, yung corporate bonds naman, lalabas, mas risky compared to T-bonds because of the default risk premium and liquidity premium. By the way, dito meron pa pala, no? Meron pa tayong R-star for the short-term borrowing. Yung short-term borrowing ng private entities. But they do not have the maturity risk premium. They only have the default risk premium and the liquidity premium. Ito naman yung short-term borrowing, no? Pero ito sa corporate naman ito. No, corporate. No? Kasi ito short-term din to eh. Pero government. This one is short-term naman for corporate. Ha? So, I hope that you can still remember them. The plus yung sa determinants of interest rate ninyo. So, nare-recall pa ba yan? Na plus? Charlene, nare-recall pa ba ninyo yan?
Yes po, sir, pero hindi na po masyado kabisado.
Okay, so anyway, at least nabalikan natin, no?
Yes po.
So, for this one, so na-explain na natin itong mga to, no? Yan. Now, between the large company stocks and the small company stocks, you can see that the average return for the small company stocks is higher than the large company stocks. So primarily the reason for that is because the small company stocks, they are more risky than the large company stocks. Especially yung small company stocks na to, no? Doon sa book ni Jordan, yung sa valuation book na, he took the lower 20% of the New York Stock Exchange. So, yung naman large company stocks na yun, it came from the Dow Jones, yung 500 na top corporations. So we can see that the risk for the company or small company stocks, the return, the risk muna, is of course high. So if the risk is high, then you are requiring higher return, di ba? Okay, naging 16.2% yan, and then this one is 11.9. So kaya itong risk premium na to, we can obtain this by deducting 3.4 from each of these. Now, ibabawas lang natin yung 3.4 na yan. For example, it's 11.9%. So 11.9 minus 3.4, you get 8.5. And then 16.2 minus 3.4, you will get 12.8. And so on and so forth. No? So kasi ang basis natin for the risk-free is the 3.4. Because if you do not want to take any risk, then do not invest in large company stocks, small company stocks, or long-term corporate bonds or long-term government bonds. So instead, you just invest in the US Treasury bills because practically it has no risk. Huh? But if you want to take additional risk, no, then these are the premiums. No, for the large company stocks, in small company, long-term corporate bonds, and long-term government bonds. So the presence of the risk premium because of the additional risk that you undertaken. Kaya dapat mag-require ka, no? Dapat mag-require ka ng additional return for taking additional risk. Now let's talk of yung return variability. So when we talk of variance, again, this is just a review from your risk and return. So variance is a common measure of return dispersion. No? Sometimes return dispersion is also called variability. So this is actually the difference from the mean. Huh? So this is the difference from the mean. So once you obtain the mean, no, and then the sources, no, for computing for the mean, you simply get the difference. Okay? May average mo siya, so magkakaroon siya ng mean, and then the variables that you use, you simply deduct the mean. So yun yung dispersion from the mean. Then what about the standard deviation? So this is the square root of the variance. No? Sometimes they are called volatility. So the reason why sometimes the standard deviation, you are using them also as the measurement for the risk. Diba? And then for the normal distribution, that is a symmetric belt-shaped frequency, no? Distribution that can be described with only an average and a standard deviation. Okay, so let's have the measurement of standard deviation using the stand alone. So sa book ni Jordan, actually, he did not include the standalone, no? Ang pinakita niya lang yung historical return, no? To compute for the standard deviation using the historical return. So idinagdag ko lang itong part na to, no? So this formula is that we have the standard deviation is equivalent to the square root, no, of the return minus the mean return squared times the probability. So example tayo. So let's see for the stock FLI. Then we have the different state of the economy. No? So we have the recession, normal, and prosperity. So the probability is 0.15 or 15%, 70%, and 15%. And then the probability for recession is negative 8% return. Then for normal is 15%, and prosperity is 35%. So we multiply these two, and you get negative 1.2, 10.5, 5.25. Then add. So the mean is 14.55. Okay? Then we take this. Ito naman ngayon, lalabas negative 8% minus 14.55 and raised to the power 2. You will get 508.50. Then 15% minus 14.55, then raised to the power 2, you get 0.21. And then you have the 35% minus 14.55, then raised to the power 2, you have 418.20. So, okay, ito yung formula natin. Ha? And then, this formula, you multiply by the probability. So, this one, multiplied by the probability. And you will get 76.28, 0.15, 62.73. And then you add them. Now you add them. So after adding them now, this is your variance, 139.16. And then you get the square root. No, square root mo yun siya. And then therefore, this is the 11.8%, which is a standard deviation. Now, if you will draw that in a normal curve, kaya kung bawa ito yung normal curve natin, ganyan. So, nandito yung 14.55. No? Tapos, nandito yung kaya itong 11.8%, lalabas ito yung plus, minus. Ha? Kaya kung plus, minus yan, if we have the 14.55 minus 11.8, so meron tayong ditong 2.75. And then on the other side, 14.55 plus 11.8, then we have the 26.35. So, ganyan siya, lumalabas, no? Kaya kung halimbawa, ano yung probability na lalabas siya rito? So, ang sinasabi, there's only a chance of 1% daw. And 1% na lalabas siya roon. Okay? So, ganyan yung sinasabi doon sa normal probability distribution mo. Ha? Okay, measuring risk using the historical data. So, let's say you have the years 2016, 17, 18, and 19, and the return is 42%, 12%, 20%, and 56%. So, the average is 20%. No? Tapos nun, since this one does not have the probability, so we simply deduct the mean from the return. No? So, ito yung 0.42 minus 0.20, then raised to the power 2. 0.12, then minus 0.20 raised to the power 0.12, sorry. 0.12 minus 0.20 raised to the power 2, and then so on. No? And you will get this. So once added, you get 0.4344. Then to get the variance divided by 4 minus 1. So this is now your variance, the 0.1448. So yan na yung ating variance value ngayon. No? And then to get the standard deviation, so we simply get the square root of this. So kaya dito naka-square root siya. So the standard deviation now is 38.5%. Okay? Clear ba yung class? So any clarification or your, any clarification?
Wala po, sir.
Okay, wala. Very good. Okay, now let's differentiate between the arithmetic average versus the geometric average. Now, so when we talk of arithmetic average, that is the return earned in an average year over a multi-year period. So, ibig sabihin, let's say this one, we have the 2012, 2013, 14, and 15. And then you have the return of 16% for 2012, 32.39 for 2013, 13.69 for 2014, and 1.38% for 2015. No? So if you get the historical or the arithmetic average, you simply add again them and then divide it by 4. So pagka tinanong kayo, halimbawa, what is the average return for the 4-year period? So the answer would be 15.865%. So even if the return for 2012 is 16, 2013 is 32, 13.69 for 2014, and 1.38% for 2015. If you are asked for the average return, the answer would be 15.865% per year. No? Kasi nag-vary siya actually. But since you are asked for the arithmetic average, then the average would be 15.865%. So the assumption there is that per year you are earning 15.865%. So what about the geometric average return? So using the previous example, ito, no? So we simply put 1 doon sa 16%. So kaya siya naging 1.16, 1.32, 1.13, 1.013, no? Kasi itong 16%, di ba, 0.16 yan. So dadagdagan lang natin yan. Kumbaga, ito yung 1, then plus R. 1 plus R. Ang hirap magsulat, no? Ayan, 1 plus R. So ito na yun. 1.16, 1.32, 1.13, then 1.013. So to obtain this, so ito ilalagay lang natin doon. And then 1.16 times 1.3239, makukuha mo yun. And then 1.5357 multiplied by that, makukuha mo to. And then 1.76460 multiplied by that one, so makukuha mo yun. So you will get 1.7701. Then raised to the power 0.25. So meaning 1.7701 raised to 0.25 kasi 4 yan. So 1 divided by 4. So you will get 1.1534. And then again, drop the 1. And you will get the 15.34%, which is the average, the geometric average return. So sino ba mas mataas sa kanila? Mas mataas si arithmetic, ano? So mas mababa si geometric. But the geometric one shows us that it is already compounded, no? Based on compounding yan. Kasi ito simply the average. Not simply the average only. But this one is based on the compounding na bala. Okay, naintindihan ba, class? Okay, what is the dollar weighted average return? So it is the average compound return earned per year over a multi-year period accounting for investment inflows and outflows. Ano sinasabi niyan? Kasi let's say nag-invest ka sa year 0. No? So let's say in-invest mo 1,000. No? Tapos pagdating ng year end, naging 1,100. So kumita ka ng 10%. Eh sabi mo, ang ganda. So on year 2, nagdagdag ka ng 4,000. So paano makukompute yan yung return mo dyan? Di ba? Eh dito sa arithmetic average at saka geometric average, we're getting yung return per year. Di ba? Per year lang yan. At dito, walang pumapasok na deposit and withdrawal. Na walang deposit and, may deposit lang siya, pero walang withdrawal. No? So, kaya nakukuha natin yung return ng ganyan. But what about if there is a return and then you deposited nga, then there is a return and then you would like to withdraw. So, paano na mangyayari ron? So, this time, we cannot choose the arithmetic return or the geometric return. But instead, we will have the weighted average return. No? So, ito siya. So, pinakita ko lang dito yung no? Nagkaiba lang kami rito, ha? Ng year. Pero pareho lang yan, ha? Kasi dito, hindi pinakita yung additional na 100. So, anyway, so, lalabas, parang ito na lang sundan natin para hindi kayo malito, no? So, naglagay siya sa year 0 ng 1,000 and then nagkaroon siya ng additional $100. So, towards the end of the year yan. Tapos, nagdagdag nga siya ng 4,000. Eh, pagkatapos dito, bumaba siya. Bumaba. Kasi dito, nag-earn siya ng 10%. Tapos, bigla siya nagkaroon ng loss na 5%. So, this time, how are you going to compute for the return? So, this time, we are going to use the weighted average return. So, simply, we can use the IRR if we want. No? Pwede rin naman yung trial and error. Kaya lang, mahirap yung trial and error na yan. No? So, dito pa, hindi na pinakita yung $100 na increase. Kasi nagiging basis natin ngayon yung ending amount, no? 4,845. So, parang ginagamit natin yung susulat ko sa Word para mas madali, ha? So, parang ginagamit natin dito. Kung nagkaroon tayo ng outflow ng 1,000 plus 4,000, plus dito meron tayong 4,845. So, we're trying to look, no? Yung return to this one, na mag-equate dito sa dalawa. So what is the return, no, of the 4845? Bakit naging 4845 yan? Tapos dito, investment yan. So parang lalabas dyan, meron tayong 1 plus R. Diba? So kasi we're trying to look for the R so that the 4845 will be equal to the 1,000, to the 5,000. So yun yung ina-explain dito. Na hindi kayang explain dito sa arithmetic return at saka geometric average. No? So dito, huwag niyong pansinin masyado yan kasi nilagay ko rito yung 1,100. No? Okay, so yan din yan. Example natin. So this time, you can use the Excel if you want or yung IRR. Hindi lang sa IRR kasi nga, di ba class, medyo ang problema dyan, if you're going to manual it, trial and error yan. So I do not know if your professor taught you that trial and error. Pero ako, I believe I taught the trial and error. No? But since ano naman tayo, naka-work from home, no? I presume that you can use the Excel. No? So kung gagamitin naman natin yung Excel, ganito class. Pakita ko para makikita niyo yung pagkuha sa Excel. Yeah, tagal bumukas ang Excel. Ayaw niya. Ayaw niya magpakita. Sandali class. Tapos nagawa ko siya 4845. Di ba? Dito niya na lang. So meron tayong 1,000. Then we have the 4,000. So the reason why this is negative, these are negative, kasi lumalabas cash investment yun diba? So cash outflow yan. And then we have the 4845 because that is the value at the end naman. No? So parang lumalabas cash inflow yan if we are going to withdraw. Now to compute for the IRR, you simply click the formulas, then go to the financial, and go to the IRR. So ito siya, yung IRR natin. Click mo lang. So click nyo to, and then highlight all the figures, then enter, then okay. So you will get the 3% if rounded off, no? But if you want to get the 2 decimal places, it is 2.59%. Ayaw niya pumunta ron. Tapos napapakita ko siya ng tignan natin para ayaw talaga mo. So anyway, kung makikita nyo, it is 2.6%, di ba? Then using the Excel, we can see also that it is 2.6%. Nakikita na class? So this time, it is better to use the dollar-weighted return. If there are deposits, additional deposits made, and then for the consideration of withdrawals. Okay? So let's go to the next. So the lesson learned from the risk and return. So sinasabi niya, the risk-free rate represents compensation for just waiting, no? And that there is the time value of money. Then the first lesson is that, actually to summarize na lang itong dalawa na to class, to summarize. So sinasabi lang ng risk and return. So the higher the risk, the higher the return. So yan lang yung sinasabi niya, no? So for the historical risk and return trade-off, we can see that risky investments represented by small company stocks, they have higher return simply because they also have higher standard deviation. So meaning mas risky siya. And then for the large company, next to the small company stocks, they have also high return. So na parang nandito siya, no? Hindi ko lang alam kung saan eksakto. And then we have this one. Kasi ito, hindi ko lang ma-class yung straight, ha? Ayan. Ganyan. Then dito. Ganyan, no? So you can see that the higher the standard deviation, wherein the standard deviation represents volatility or risk. So the higher the risk, no, the higher the average annual return, or the higher the return. So if the investment that you will undertake has higher risk, then you should be requiring higher return. Okay, maliwanag mo yung class. Okay, so actually we're done. So that's the end of the lesson. So